Hi, this is Michael King, and we're at part 2 of Equity Capital Markets and IPOs. In this second video, we're going to look at the IPO process. We're going to look at the forms of prospectuses, both the preliminary and the final prospectus. We're going to talk a little more about underwriting and the over-allotment option known as green shoe, and we'll review some important documentation. The IPO process is long with many steps. It starts when the founders and the insiders get approval from the board to sell shares. They choose the lead investment bank. Once they have picked their lead book runner, that lead book runner will conduct due diligence on the company and begin the process of registering the company to do an offering and the preparation of a preliminary prospectus. That prospectus is a long 100-page document that is reviewed by regulators, and once it's approved, the underwriter will form a syndicate by inviting other investment banks to come into the deal. There will be a marketing roadshow of 1 to 2 weeks, during which time the investment banks or underwriters will be collecting orders from institutional investors on where they want to purchase the shares. Armed with this book of orders, they will set a meeting with the issuer and set the final price. The price will be set and the shares will begin trading. If the deal is successful, there will be an opportunity to increase the number of shares subsequent to pricing by 15%, which is known as the over-allotment option. After a week, the syndicate breaks and the shares begin trading in the secondary market. When looking at this process, there are 3 phases. Phase 1, preparing documents and the due diligence. Phase 2, marketing and book building. Phase 3, pricing and closing. The longest and most time-consuming part of this process is preparing the prospectus and doing due diligence on the company. The underwriters want to make sure that all information that they provide to the public discloses any material facts that would be important. If they do not, then the underwriters themselves could be sued by investors subsequent to the offering. The regulators, known as the securities commissions, have to review the document for its completeness before approving it in order to protect investors, particularly retail investors. Marketing and book building can happen very quickly or may take longer depending on the story that the company has to tell and market conditions. Pricing and closing the offering will usually take 2 to 3 weeks. Following the offering, the shares will begin trading. The whole process can take up to 15 weeks. The underwriter is the name given to the investment banks who actually commit to buy the shares from the company if they're not sold to the public. This is known as underwriting. Through the process of book building, however, these investment banks rarely have to buy the shares because they market the offering and price it to sell. The group of lead managers, co-managers, and other syndicate members is called a syndicate. The syndicate is led by the lead left book runner, whose name appears in the top left position on the IPO prospectus. The lead left book runner is responsible for preparing the prospectus, coordinating marketing and the roadshow, negotiating pricing with the issuer, and stabilizing the price following pricing. The lead left book runner may be one of several joint lead managers who are running the deal. These lead managers have their names written in large bold font on the front of the prospectus, and they will underwrite and sell most of the shares. Below lead managers are co-managers who underwrite a smaller amount and play a smaller role in the IPO. Many investors will want to create pro forma statements, which are statements that are adjusted to show the impact of a material transaction. A prospectus will not include forward-looking information, so investors will have to create their own pro forma statements in order to value the company. Another important part is due diligence, which is a process whereby lawyers and underwriters will meet with the company, ask questions, verify contracts, and ensure that all material risks are disclosed in the prospectus. Let's take a look at this preliminary prospectus filed on Form S1 by Facebook back in May of 2012. This document is known as a red herring. Notice the red writing at the top which says that the prospectus is not complete and may be changed. This document has details about the company and the offering and is used during the marketing phase. However, it is not final and can be changed, which is why it gets the nickname the red herring. The red herring has information that is important for investors, in this case disclosing the total number of shares that are being sold, as well as the class of stock that is being sold, Class A common stock, and the number of shares that are being sold by insiders through a secondary offering. In this case, 241 out of the 421 million shares. There is also a price range or price talk of $34 to $38 disclosed on this red herring, and it discloses information about the votes. The Class B common shares are not being sold and have 10 votes, whereas the Class A common shares that are being sold have 1 vote. It discloses that Mark Zuckerberg controls 95.9% of the Class B shares and therefore has total voting control of 56%. Once the deal is priced, the final prospectus is filed on Form 424B. This finalized document will include the price that is used, the total number of shares, and the underwriting commissions. In this case, Facebook went public at $38 a share. The total proceeds from the offering were $16 billion, of which the underwriting discounts and commissions to the underwriters was $176 million. Notice that Facebook would only receive $6.7 billion and its selling stockholders received $9 billion. That is the secondary offering, with that cash going directly into the pockets of the insiders who sold in the IPO. If you look inside an IPO prospectus, you will find that it is a long document, in this case over 170 pages, with many sections disclosing facts about the company, basic financial information, typically 3 years of financial information, a management discussion and analysis, details on who the principal stockholders are and who is selling, as well as a long section on risks for investors. The underwriting table itself lists the banks who are helping the company to go public and how many shares they underwrote. Here we can see that Morgan Stanley was the lead left book runner. They underwrote 162 million shares, followed by JP Morgan with 85 million, Goldman Sachs with 63 million, and Merrill Lynch with 27 million, and Barclays also with 27 million. You can see that the number of shares is declining as we go from lead managers to co-managers. Now there are several different types of underwriting. The type that is used in North America is typically called firm commitment underwriting. In this case, the underwriters make a firm commitment to buy all the shares that are being sold by the company at a fixed price. There are 2 types of firm commitment underwriting. There is a marketed offering and a bought deal. In a marketed offering, the company will go on a roadshow led by the underwriters who will build a book of orders and price the deal so that the underwriters do not have to buy the shares. In a bought deal, however, several underwriters or banks will approach the company, buy all the shares that they want to sell from the company at a fixed price, and then turn around and sell those shares to investors, taking the risk that those investors may not buy the shares. For a bought deal, the underwriters will buy the shares at a discount and sell them at a higher price in the hopes of making a profit. If the shares are overpriced or if the market does poorly, then the underwriters in a bought deal may be facing a loss. Another type of underwriting that is very infrequent is called best efforts underwriting. The underwriters do not commit to buying the shares, but only commit to marketing the deal and doing their best efforts. Almost like a real estate agent who will not buy the house, but will introduce buyers to sellers and will take a commission if the sale goes through. There is no guarantee, however, that the securities will be sold. A best efforts underwriting is not a frequent form of underwriting in North America. Let's talk about the over-allotment option, otherwise known as the green shoe. It's called the green shoe because the first time this option was used by the underwriters was for the Green Shoe Company of America in its IPO in the 1960s. The standard form of a green shoe is to have a provision on the front of the prospectus allowing the underwriters to sell an additional 15% of shares in the 30 days prior to pricing of the deal. Effectively, what the underwriters do is they allocate 115% of the shares that are being sold. If the price rises in the aftermarket, they can increase the deal size by exercising this option, and they will have already pre-sold the shares. If the price falls, however, the underwriters can now buy back up to 15% of the shares that were not created and were sold short using the capital that was paid by investors. Effectively, 15% of the shares were created but never existed and are bought back in the days and weeks following the pricing. This purchasing in the secondary market supports the price while limiting the downside to the underwriters. When demand is particularly weak, the underwriters may over-allocate and take a naked short position, looking to buy back shares as the shares fall. This is very infrequent. Let's look at the example of Twitter, which went public in 2013. The underwriters were Goldman Sachs, Morgan Stanley, and JP Morgan, who committed to sell 70 million shares. They actually sold 80.5 million shares, which was 115% of that amount. The shares were priced at $26, but on the first day of trading, they closed at a remarkable $44.90, or an increase of 73%. The underwriters therefore exercised the green shoe, and the company received proceeds on the additional 10.5 million shares, which had already been placed with investors. The IPO raised proceeds to Twitter of $2 billion, based on 80.5 million shares times $26. If the shares had fallen below $26, however, the underwriters would have been able to buy back up to 10.5 million shares using the cash that they'd already received from investors to cover their short position. An over-allotment option, therefore, protects the downside for the investment bank while giving them the upside of additional fees, and it benefits the company because the company can get higher proceeds if the deal is successful and the price is stabilized if it is not. Another provision in the underwriting agreement and the prospectus is known as a standstill agreement or a lockup agreement. Effectively, this agreement says that insiders, whether it's the founder, their initial venture capitalist, or other pre-IPO investors, or the company themselves, cannot immediately sell equity, which would put downward pressure on the shares that are outstanding. The minimum standstill requirements are typically 180 days, although they may be shorter, and for SEOs and secondary offerings, they may be 90 days. The company is restricted from selling other forms of equity directly or indirectly in the form of preferred shares, convertible bonds, or other equity-related securities. They are also not allowed to sell through a private placement for 4 months following the IPO. This provision is there to protect investors who buy in the IPO from seeing additional shares being created and putting downward pressure on the share price. As you can see in the case of Facebook, there was a lockup of a large number of shares. These shares were restricted and could not be sold by insiders for anywhere from 91 days up to 1 year following the IPO. Looking at Canada, we can see that there are 4 different marketing documents that are used by underwriters to market a deal. The preliminary prospectus, a term sheet which summarizes on 1 page the terms of the offering, including the issuer, the size, and other timing of the roadshow. A green sheet, which is a sales document used by salespeople when talking to investors, which contains information that can be used to market and sell the deal, such as how the company is priced relative to comparables. And finally, a management presentation used on the roadshow and may be available to institutional investors during the roadshow through a website such as netroadshow.com. Prospectus types in Canada can be one of 4 forms: the long form prospectus, which is the longest document, a short form prospectus for an issuer that already is reporting and can therefore incorporate information by referring to other documents already filed, a shelf prospectus, which is alerting the public that the company plans to sell securities in the future and contains important information without having any information about a particular deal, and a post-receipt pricing prospectus or PREP, which is similar to a final prospectus but has no pricing information. When using a PREP, the company will have to issue a subsequent amendment that will include the pricing information after the deal is priced, similar to a final prospectus relative to a red herring. There are also a number of legal documents that you can see here which are used by the underwriters and the issuers, which are going to be available, particularly when a deal from Canada is also being sold into the United States, or for a company that is selling shares through a private placement. That's it. Thank you very much for your time.